Howdy, swings. Yesterday, we had only positive expectations for NVidia. Despite this, the market declined before NVIDIA's earnings report was released. Surprisingly, the semiconductor sector, which includes companies like NVIDIA, led this downturn, which was unexpected. Is this a temporary dip caused by short sellers? Or is it the beginning of a downward trend? Let's take a look at Fullhapce daily swing market forecast to get some answers. Let's review daily market index movements. Market went lower broadly. VIX went up big. SPX, 5,592.18, minus 0.60% down. Dow Jones, 41,091.42, minus 0.39% down. Nasdaq, 17,556.03, minus 1.12% down. Russell 2000, 2,194.3, minus 0.72% down. VIX Index, 17.11, 10.89% up. Let's look into daily sector performance. Financials, healthcare, defense contractors, transportation, and utilities performed well. It's interesting to see that finance is performing the best ahead of the correction. Technology, consumer discretionary, autos, airlines, and materials underperformed. Here are the reasons. On Wednesday evening, NVIDIA's stock price faced downward pressure due to worries about its earnings announcement. This stock price decline was caused by the company's failure to meet investors' high expectations, which caused concern among investors. Another issue that impacted the market was SMCI, whose stock price plummeted due to the company's own issues. This stock price drop negatively impacted people's thoughts on technology stocks, especially those related to artificial intelligence. Other than these earnings announcements and the SMCI issue, there wasn't much news, and the overall market sentiment remained the same. Here are the things to consider. Consumers are facing challenges in the current economic climate, but some retailers are still reporting good results. The technology sector is showing positive results in earnings reports. Diplomatic discussions between China and the United States concluded Wednesday morning in Beijing. The White House described the talks as constructive. According to the deputy director of the CIA, Russia may find it difficult to regain the territory captured by Ukraine in the Kursk region. This situation could give Ukraine a strategic advantage in ceasefire negotiations. Tensions are showing signs of easing after Houthi rebels agreed to allow a rescue operation for a damaged oil tanker in the Red Sea. Wage growth slowed to 4.7% in July, down from 5.3% in June and May, according to the Atlanta Fed's wage tracker. Here we present the daily market forecast for swings. The weekly market potential is bullish. The daily market is weak, but there is some upside momentum as a reaction to today's decline. The S&P 500 index, SPX, tested the 5550 level today, but found strong support and eventually pushed the market to the 5,600 level. While it was part of our expectation that the market would oscillate between 5550 and 5650, today's unexpected pullback may have spooked investors. Today's decline appears to be a short-term event influenced by short sellers who bet on a decline amidst the overwhelmingly positive NVIDIA expectations. The situation could reverse as the September Federal Open Market Committee (FOMC) meeting approaches. Uncertainty usually increases when markets test all-time highs, but we think there will be a reaction that offsets today's decline. We are leaning towards the idea that the market could recover some or all of today's losses on Thursday. If that happens, we expect the market to move modestly higher after struggling somewhat to break above the 5,650 level. Some additional insights are as follows. The number of jobs expected to be added in August is around 155,000, slightly higher than the 114,000 added in July. The unemployment rate is expected to fall slightly from 4.3% to 4.2%. In recent speeches, Chairman Powell, a leading figure in the economic community, has emphasized preventing unemployment from rising. Regardless of whether the rate cut is 0.25% or 0.5%, the next few months are expected to be dovish. Improving job growth with a smaller rate cut is considered more favorable than sluggish job growth with a larger rate cut. The opposing scenario is that the bear market continues without a recovery and tests the SPX 5450 support. In this case, it could be an opportunity for bullish traders to wait until SPX 5450 is approached and buy low. The rationale is as follows. Usually, when the market makes a second attempt at a new all-time high, it often fails and goes into a rather long downtrend. The decline in NVidia stock price in the absence of any bad news about NVidia and in the face of positive forecasts highlights the dangers of high expectations in a market where NVIDIA's performance is not just good enough. While SMCI's individual company issues were due to its own problems, the significant share price decline had a negative impact on the overall sentiment of the AI industry. Overall consumer spending is struggling, as evidenced by reports from a number of companies. Bank of Japan officials hinted at a possible future rate hike. Officials at the People's Bank of China are concerned that interest rates could spike in the near future. We think the opposite scenario is feasible, so traders may want to consider this thoroughly when setting up their positions. We believe the weekly market is bullish, but the daily market is bearish with a lot of uncertainty. The market fell today against our forecast, but we expect a modest rally to continue after eventually breaking SPX 5650 with difficulty. The direction of the market now depends on the performance of shorts before Friday. We are slightly hopeful that today's losses will be recouped on Thursday. If that happens, it may be wise for traders to stay bullish and do nothing, or at least buy a small amount, if they have already added to their protective positions as we discussed yesterday. It may also be wise for traders to consider both our main forecast scenario and the opposite scenario to effectively manage their risk. Thank you for watching. Fullhapce Intelligence, the best investment partner for swing traders.